Hi, how you doing, guys? Blake Preston, Royal Page Commercial Real Estate. I'm just bringing you a new podcast, webinar, whatever you want to call it, informational talk about where the state of the current commercial real estate market is, and it's May 10th. So here we go. First thing that we need to keep in mind as we, move forward is that, we have to keep looking forward. The most common question we hear from everyone is, how long will this last? But, I think the wrong question is, I think that is the wrong question, because when it's over, it really doesn't matter. The fundamental question is, when does it feel like it's getting better? And when is positive sentiment going to come back into the market? And, when will things return to some sense of normality? The signposts obviously will be, flattening of the curve, and as well as there being unlimited testing. And these are signals that things are improving. But, if I have any advice for you to protect your mental health, do not read the paper too much. Just keep your head down, stay home, pet the dog, find a new hobby, work extra hard, do something that just keeps your mind off where we're at. Because, we're all in this together, as we all know. And, if anything, it's nice to see people who don't know each other saying hi to each other on the street, people making distance for other people because they know that their actions affect other people. So anyway, just as we move forward, there has been a notion that the market has been recovering right now, because there are people who pulled money out to go liquid at the beginning, and now they're starting to put money back into the markets. And that's a key indicator that suggests that we're well past the bottoming out of the market. And people are feeling somewhat positive. There's a lot of talk, like the other day, I was talking to a guy from Life Labs. And he was basically saying, look, we understand the pathogen. We understand how it acts. We've seen this 100 times. It's not like AIDS where we didn't understand or know what it was. It's a pathogen that they understand the blueprint. So now it's just figuring out how to work within the confines of that information and knowledge. And, he basically was saying they're testing thousands of things right now. And as we saw, the FDA in the States the other day announced that they're allowing people to utilize a drug that is helping patients that aren't critical, but patients that are ill recover much quicker. So we're on that road, and I think that's one of the reasons why people are seeing and feeling positivity and looking towards putting some money back in the markets. There's certain things that people will definitely make money on as the market rebounds, right? So what we're seeing right now is e-commerce has been elevated between 40 and 40% right now, over a projected 23% for the year. Companies that are cash heavy are obviously very sustainable right now. And as far as looking at why e-commerce wasn't adopted as readily as it has been now during the pandemic, one of the key features of that is that baby boomers were late adopters to this, and now definitely they're in the habit of doing e-commerce. E-commerce is fundamentally where people are shopping, and it's not brick and mortar activity. At some point in the future, I do want to take a deeper dive into what's going on with retail right now. I'm going to touch a bit on that a little bit further, because there's some interesting developments in that aspect of commercial real estate. Definitely it is the sector that is hurting the most, but e-commerce is picking up on that. And in turn, that is strengthening the industrial market moving forward. So I was on the Prologis public call the other day. Prologis, if you're not aware, one of the world's largest landlords, publicly traded company. And I think they're very stereotypical of where the rest of the publicly traded REITs are at. And, they were saying quarter one was strong. And at this point after April 1st, because April 1st was kind of D-Day with what's going to go on with rents, they're saying, and you got to keep in mind, Prologis does cater to a lot of the Fortune 500 companies. The majority of their business is large-scale industrial, but large-scale industrial, just like any other indicator, is a signpost for where the rest of the business is headed. So we have to pay attention to key indicators, and key indicators are, for them right now in the industrial sector, 60% of their tenants are growing and 40% of their tenants are shrinking. And one thing to keep in mind for the 60% that are growing is they're definitely folks that are involved in either medical supply, food chain, food supply, as well as personal services and effects, personal goods. We can get into how this is transforming the supply chain eventually, but for now, talking about, to go back to Prologis, they're saying that their lease proposals are up right now as far as like their square footage goes. You have to keep in mind that for Canada, before this happened, our industrial vacancy rate was about 4.5%, and that's across the country. And that does include, not really serviceable inventory, in that they're old manufacturing facilities that aren't really suited for warehousing. They're not just strict vanilla boxes that people put their goods in, and 3PLs take them all across the landscape. But at the end of the day, it was 4.5% going into this across the country. In the GTA, and I will lump Halton and kind of a lot of the surrounding areas of Toronto into the GTA, there was definitely a vacancy rate that hovered around 1%, and that's from every kind of size category. Definitely on the tertiary areas like Guelph, into Hamilton, there was vacancy, but I mean, still not the same. It's still hovered quite low. But if you lump it all together, you're looking around 1%. So, for all the groups that need space, is very much like a patchwork happening right now that we're going to get into momentarily. But definitely the large tenants are doing better than the smaller ones. There's a lot of smaller tenants right now that are getting roughly 90 days worth of rent deferral from some landlords. I'm not going to specify exactly which ones, but it's definitely a trend that we're seeing. The smaller tenants are deferring the need for their goods. So if they can survive, we'll all thrive. Like it's really, yes, there's a good indicator from the top, but there's a lot of, pain on the bottom end. So literally, we were hovering, if you were to go sub 10,000 square feet, vacancy rate's almost zero everywhere, and it has been before this happened. So there will be some pain in that area, definitely. I mean, I would tell everybody that if you're in that size category, make sure you reach out to the government. I'm going to put some links up in the bottom of this YouTube broadcast for you to click on and kind of get some further information from the government. Our tax dollars are definitely working to try and keep people afloat. And we've seen that the government and the banking response has been reflected in the fact that everyone's kind of the we are all in this together mentality and working to help businesses out. Now, also to understand indicators, you do have to discern between large companies and mom and pops. But, the government is reaching out to help businesses of all shapes and sizes. So I do tell you to go figure out if you're available for some help, because all of us are going to pull each other up in this. I will say to kind of shift gears for the tenants that are looking at spaces. Right now, there's definitely an interesting new tour protocol. I mean, I just sold a building in Cambridge conditional, and I wasn't at any of the tours. We had multiple tours. I set it up where I was available for video call. We had every single door and window open, as well as shipping doors, and you were marshaled in. You had a 15 to 20 minute window. Your group had a half an hour window. You go in. You don't touch anything. You don't talk to anybody. You're in, you're out. And then, the next group is lined up in a car waiting for your car to leave the parking lot. And it just kind of cycled through. We had one day where there was 8 tours working under that auspice. But anyway, I think, the regular tours are starting to resume with people being on site. I know mine was a little bit maybe, over dramatic, but I'd like to keep everybody safe for sure. And at the same time, too, we had people sign off on liability, and that's sellers and buyers. But, the trends that we will see coming are face covering, hand sanitizers, gloves, and all that are going to be a daily standard for tours. Tenants are going to stagger their arrivals just like I did. And, there's pre-registration technology that's going to allow, turnstile badges and things like that in your cell phone app that allow people access, things like that. If you're looking at like office spaces, long elevator lobby lines and crowded elevators are not going to be something that happens. Everyone's going to be spacing it out. It's very much like people looking at technology and ways to physically distance and have that kind of hardwired in the machinery that gets people around the building. Touchless bathroom fixtures are now going to be in building codes. I've heard that's a new thing coming out. So if you sell bathroom fixtures and you're listening to this podcast, make sure you're rolling out those cold calls right now, because that's you're going to be in high demand. And as well, there's going to be a lot more visible janitors on site. for the larger, facilities that have tenants in common. They're going to have face coverings and all that stuff because you want to make sure everyone's safe, right? So cleaning specifications and the cost to clean buildings will expand. So I think tenants can obviously, expect some sort of bump in their TMI at some point. There's going to be different protocol for lobby gatherings and along sidewalks for most retailers. Like, there's definitely a reorientation of the spaces, but I think everyone's working under the expectation that now eventually there will be a vaccine. And to go back to what I was saying earlier about the gentleman from Life Labs I was speaking with, it's really the case that we can be very thankful that they understand this bacteria and they understand its blueprint. And here's hoping that nothing else arises like this that we don't understand, but at least from here on out, one would hope that we all have the protocols in place as governments, as provinces, and as cities to help combat this should something else arise, because this definitely left us wide open, but as we say, and I've had a couple of, guys I know, senior guys I consult with for information that have said basically they've been through everything. Maybe not everything, but a lot of recessions, a lot of issues. It's not the end of the world per se. It is definitely a time when we have to come together to help mitigate pain. I did have one gentleman, refer to this, in the most strictly in a sense of metaphorically looking at it through the lens of business. But he said, sometimes there has to be a forest fire for it to stimulate new growth. And, I'd like to believe that, and obviously this is no disservice to the loss of life or anything like that. It's looking at it metaphorically at what we can expect moving forward, and there will be new opportunities, and there's going to be new availabilities coming. In my last podcast, I touched upon obviously what's going on with the industrial sector, and I will discuss it throughout this broadcast as well and moving forward, because as we examine the commercial real estate market, it would appear very strongly that industrial is the safest investment moving forward and going to be the segment of commercial real estate that rebounds the quickest. So we have to ask ourselves, how do we capitalize on this opportunity, right? Now, landlords are pushing for increases continuously, or were pushing for increases continuously in the last few years. But now they're starting to work just to occupy. And again, vacancy rates are low, but there is space in a lot of the new spec buildings. There's deals that wouldn't have happened that are taking up those spaces. Like, large landlords are doing short-term deals in a space, like if you have a 500,000 square foot building you just built in Milton, the appetite to do a 100,000 or 250,000 square foot, short-term deal is really not something that people were entertaining. They were looking at 10 years. They wanted bumps. But really the case now is like people are putting up caution tape, and you put your gear here and we'll sign in for, a short-term deal, maybe for a year, maybe at 20% off, but people don't want to sign long-term deals in that space and allow for, them to have a compressed leasing rate when the market rebounds in the next year or two or whatever it takes. But it's not in 10 years. This is going to be a blip that is well in the rearview mirror. Now, a lot of spec construction has been paused, so obviously the government's shutting things down. So I feel like most of the space will get filled up, just due to the lack of it, because the metrics are saying that for every new $1 billion in e-commerce growth across North America, there's a need for 1.3 million square feet of warehousing, and that comes in all shapes and sizes, whether they be large vanilla box, 500,000 million square feet, or they be 2,000 square feet for some guy who sells widgets. It's really the case that it's multifaceted, but the demand is there and it will continue. Microsoft has released multiple reports now saying, and they're of the opinion that once these habits are set, these habits are going to stay. And a lot of people agree with that. So e-commerce and the growth that it's experiencing will continue, and e-commerce is not going to disappear. Brick and mortar is getting hurt right now. So we'll get into some of the shifts that are happening in retail right now. But there was a report released recently that I wanted to key in on that focused on the impacts on the food industry and the implications for industrial real estate. Now, E-commerce has had more than 100% increase in daily online sales from March 13th to March 15th compared to March 1st to March 11th. Now, 46% of respondents to a survey by Brick and Click say they will continue to purchase goods online after the pandemic, and 95% of food produced or imported goes through third-party logistics food distribution centers, meaning there will be an anticipated growth in cooler and freezer space in the near future. Now, perishable goods were becoming the one thing that was lagging in e-commerce prior to COVID, but now they are at the forefront. So, third-party logistics groups were definitely set up for just-in-time delivery, and now we're getting to a space where, like, you know, the staging bays are full. Depending on what type of facility it is, the staging bays are definitely being crowded with stuff that has to get out the door immediately, and they're having to shift and be able to kind of have a staggered approach to, you know, perishable goods in one area close to the staging bay because they're moving quickly, and then stuff that's non-perishable getting pushed to a different part of the building. So definitely reconfiguring the way that they utilize their space, and again, creating demand for more industrial space. Now, typical e-commerce grocery is fulfilled by local grocery stores, and it's causing a need for more infill of temperature-controlled spaces, and restaurants, with their shift in orientation away from dining room service to delivery and takeout, are definitely contributing to that. It's currently second-generation cold storage facilities that are helping with the requirements for restaurants and smaller users. But there's a definite growth in speculation that there will be a mass consolidation of the publicly traded refrigerated warehouse sector to increase the footprint and a need for specialized development in larger cities. And automation of cold storage will prompt higher density, greater height, and smaller footprint buildouts. I actually went into a building in Guelph. The Tim Hortons warehouse is a great prime example. If you drive into the south part of Guelph going up Highway 6, you'll see a kind of odd, nondescript, tall building with a small footprint, and that is definitely the Tim Hortons warehouse. And if you walk inside, it's like there's a vast portion of that building that is literally dark, and all you can hear is machines whirring and clicking around. It's like looking in the inside of a pop machine. And literally what happens is, you know, these automated cold storage facilities, or even just automated facilities, have a pick and pack computer, pick and pack system that builds skids, and it's next, you know, you order what you need and the skid comes out at the bottom. Very few people working per 1,000 square feet. As an aside, that sort of shift in building will have to force governments to reorient the way that they look at their tax, at the tax implications of the industrial land that they utilize, because they usually say, well, you know, they project X amount of people will work per acre. They say, with BOMA standards, you could put 20,000 square feet on an acre. So for every 1,000 square feet, you know, every municipality has an expectation for how many people will be generating tax dollars. You know, that's a long-term issue. It's something that we can dive into at a later date, but it's just something to keep in mind. But yeah, there's going to be smaller footprints and greater height and greater density coming in the buildings moving forward that help push the food industry forward. Now, I want to get to a point where I just want to dive in here and look kind of at the concept of pre-COVID and post-COVID as it relates to transactions. And most deals right now that are occurring are pre-COVID. I can say for myself, I have a couple of transactions that were tied up coming in right now, and they're coming together. So, you know, it's definitely, well, I guess I'm a bit of an exception because I put that building sale together last week. But, you know, I would hope that I would be the rule, but I think I'm slightly the exception of the rule right now. We had a very concentrated marketing effort, very in depth, and we were able to dig up what we needed for the seller. And anyway, moving forward, you know, we're watching deals, that happened post-COVID. And one thing I would tell you, I'm going to take a stop and a pause here to get your attention. But one thing I think is very important that people have to do, and this is after talking to numerous folks, I would say, and I'm not the only one of this opinion, that businesses should make an insurance claim for a business interruption claim. It's not necessarily because the insurance company is going to honor it, because insurers have already come out to say that business interruption insurance does not apply right now. But there are perspectives out there that there are going to be a lot of lawsuits around this. And there have already been conversations between the government and some insurance companies about the future of claims based on COVID. So the point is, if your company has already registered a claim, they'll have a means of having demonstrated initiating the process. The lawsuits will eventually dictate the direction of the claims, with many believing there's a high probability that these will get paid out eventually. So get on the front line of that. Get out there right now. Go talk to your insurer and file a claim. Do it. Get on the offensive. And of course, you need a legitimate cause that's demonstrative. But in this time, we're all feeling the pain of market compression. So, let's look for the tools in the tool belt to help succeed and move forward past this with the best foot forward, right? So if you guys, have any comments, feel free to put them in the comments below, and we can initiate a conversation that way. Now, to talk about transactions and how they're getting done, in terms of due diligence, environmental companies are considered an essential service, and therefore they're able to be open and operating. In the post-COVID transaction era, people have been able to complete their environmental due diligence at a pace that was very brisk. So the same goes for building inspection reports, and it's just good to know that that's expedited if you're in the middle of a sale process. Now, as we look forward, I think it's important to ask, what, if any, impact will we see in the auto industry? Because, obviously that's a big employer in North America. And, something that piqued my interest initially was Toyota has already released a statement that they believe that due to people not wanting to utilize public transit in the manner they had previously, there will be a resurgence of sales in their sector. I mean, we have Toyota in Cambridge, we have Toyota in Woodstock, we have a lot of manufacturers, we have the Hassenfratz family in Guelph, Linamar doing a lot of work. There's a lot in that industry, in the area, and we're already seeing, ideas that manufacturers are speculating that there's going to be a clawback of some foreign manufacturing to domestic markets, because we're obviously seeing the most exposure in the manufacturing sector, and I think the largest exposure we're seeing obviously is in the medical field. Perfect case study is previous to the hurricane that hit Puerto Rico, they had two factories there that manufactured 75% of the IV bags for the world. Let me say that again, 75%. Both those factories got wiped out by the hurricane. So they're coming back online now, but at the time, the world supply, 75% of IV bags concentrated in one spot. I mean, you can really look at the fact that companies, when they rolled jobs out of North America, didn't look in the rear view as they move forward. But I think this is definitely a time to take pause. So I want to shift real quick back here to kind of the mom and pop area of the world. Obviously, when we're talking about auto manufacturing, it's the big players at play. I mean, for every Toyota, there's 50,000 Joe's Widget Shop. So anyway, now some landlords are saying April wasn't as bad as anticipated in the industrial sector, but for other sectors, the mom and pop businesses, they were tough, very tough, and roughly 45% by the numbers, are asking for rent abatement or not paying that month of rent. And I mean, most of these mom and pop businesses are all kind of sub 10,000 square feet. There's a bit of pain there, but again, the government is looking to help all companies, and especially the mom and pops. So if you're in that scenario, look at the links below, get a hold of the government, figure out how you can pay your rent, because your landlord, he loves you too, and he wants to see you succeed. He or she want to see you succeed. So get out there, find out what's available to you to help you keep your head above water during this, because we're all in this together, as we say. So for right now, banks are sitting on their hands, waiting to see how this all shakes out. The common thread right now about lending is that lending is getting done based on deep relationships. And this is for landlords and tenants. and people just trying to keep their businesses afloat. I would say reach out to BDC if you're running a business as well. If you need some sort of loan that the government can't provide you with, BDC is expediting what they're up to. Definitely they're an arm of the government that's their mandate is job creation as opposed to a traditional bank that's just trying to, get your interest. But as far as banks right now, they're basically kicking the can down the road for most lending until perhaps there's a better clarity in the market and the Treasury departments have calmed down. And they're ready to begin on quoting on new business. I think when things do take a turn and things are reorienting themselves in the commercial real estate business, that things will turn fairly quickly as there is a herd mentality when it comes to things like this. People come together because, we all are chasing the same sort of things, right? So one shows us the signpost and the way to go, and we all follow. So, it's not going to be everyone hitting the market at once, but there will definitely be an upswing. As for lending, currently there are many banks putting down their pens, but there's financing deals that are coming through, credit unions and smaller deals, smaller companies, and they're picking up the smaller deals. You're seeing interest rates that used to be at 2.6 or 3 jumping up to 4. I mean, it all depends on your relationship with your lender, but if you're trying to finance something, do feel free to reach out to a credit union as well. Now, people have been asking for those that recently purchased a building at top of market that may be having trouble servicing their debt, how patient are banks going to be? And as this question arises, so does the presupposition that there will be an opportunity down the line. So with this, we have to recognize May 1st and June 1st will be big dates from the perspective of lenders, as there's a desire for banks to work with their borrower clients. They don't want to have a chunk of deals that they have to work through in a manner of disposition or foreclosure, and they don't want to put more undue pressure on borrowers. It's already a stressful time, right? The reality is this is a case-by-case situation, though. But the general consensus is that it's all about pragmatism and sensibility at this point. People are asking where they start with their bank and their financing needs, and I would say be prepared to work within the confines or freedoms of the existing relationships you have with your lender as far as it goes to large lending. And for a building purchase, definitely, or at least for larger loans, they're going to be examining on a much more granular level things like cash flow, income statements, and their due diligence is going to be a little bit broader, and they're going to open the aperture than they used to previously. That's for sure. But if you're a landlord looking for help, you'll have to present a very concise and clear picture of why you need help. A great example of people on the wrong side of this is just recently downtown Toronto, there's a large office building, 100% tenancy by the government, paying their bills, definitely. And the landlord was trying to not only renegotiate their rental rate, but looking for a rental abatement. Or at least, they were looking for some help from the government. And it's like, no, we're paying our rent. But, it's everyone's trying to skin the cat, take all your tools out of the tool belt. But now, I feel like there's going to be a much more refined approach from lenders in the case of refinancing for landlords that can and will include a much more broad understanding of your tenants, their profile, and how they fit into a larger picture of businesses that will survive this, thus getting a better appreciation of expected cash flow in the future. Just because they want to set an expectation for future risk, right? Now, there's been a lot of conversation about the notion that there will be a lot of institutional sales of buildings and that there may be an influx of sales from private owners that can't meet their debt obligations that are under distress. And I'm sure we're going to see some of that. And, if you want a heads up, wink, wink, you send me an email and I'll make sure I get you some information on stuff that comes up. But, you really have to be ready to pounce because historical data suggests there's going to be a small spike, but you have to be prepared to jump on that. I mean, at the end of the day, the data from post 9/11 and post 2008 suggests that rental rates compressed for a while. And I mean, looking at it from a lens of a 10-year perspective and not 6-month or 2-year cycle. From a 10-year perspective, lease rates generally did not drop too much, and per sale per square foot pricing did not drop extensively. Like it did in some tertiary areas, but the spike wasn't, prolonged. It's really the case that inherent in real estate is scarcity. And we talked about this in the last podcast. If you want me to kind of delve in further, feel free to leave a comment at the bottom. But scarcity of real estate is, something that is sewn into it. So that's always going to drive up the price per square foot. So for now, be ready. Be ready to jump, because there are going to be a few deals, not many. So, I'll be your advisor. I'll help you out with that. Anyway, the reality is that there is an end date to this. And the reality to this is that there may be less in the way of distressed sales than we think there will be, but there will be a few, so be ready. Anyway, now, in regards to large format distribution industrial sites, which is where we're going to shift to right now, there's been a lot of conversation about institutional landlords doing smaller term deals. We touched on that a little bit earlier. But apparently there's a bottleneck in Long Beach that's causing congestion with goods, which is forcing them to be rerouted up to Vancouver in the effort to get it out to Toronto in the eastern part of Canada. Vancouver already had a very tight leasing market, but to accommodate the overflow for retail and food companies, they're really having to get creative for solutions. The congestion issues are coming from a backlog of goods coming in from China as they've reopened, right? So as for build-to-suit facilities, they're all being delayed due to parts of the economy being shut down. And for those that can still be building, their tenants are having to turn around short-term solutions due to build-to-suits not being completed on time or being able to be finished because some materials aren't available. There's a lot of patchwork happening. And at the end of the day, Walmart said that after this started, their web traffic was up 50%, Couple that with what Amazon is calling 3 times their busiest Christmas or 4 times their busiest Christmas now. There's opportunity within the industrial sector for sure. And these large multinational groups are scrambling in a patchwork fashion to secure solutions for their growing requirements in a low vacancy market. And as far up as Premier Ford, they're saying that there's going to be a loosening of restrictions on builds that help facilitate requirements from the food and medical industries in the short term. A lot of landlords are taking the position that this is an opportunity to strengthen relationships with larger tenants by doing favors for them, And in terms of retail, there would appear to be an appetite among many landlords to work out warehousing within retail spaces that are dark to mitigate their income loss. Now, there's an excess of retail space in the 30,000 square foot plus category that can act as a bit of a band-aid for industrial users while the retail market rebounds. There's a definite belief among retailers that their sector will take the longest to stabilize, and vacancy is at a rate that it has not been traditionally seen. So in regards to some of the many big retailers, there's been a lot of talk of significant pain that they're feeling currently, and this goes for their landlords as well. There's a significantly high proportion of businesses looking for help from either the government or their lenders within the retail sphere, and this is causing some major warehousing companies and manufacturers of certain goods to wait and see how this all plays out. If certain retailers are going to be closing their doors because of COVID, coupled with the shift in habits away from traditional brick and mortar retail, there's going to be a need for a reconfiguration of warehousing and distribution among many major tenants. And many economists think this will lead to a debt-led recession that's going to be exacerbated right now by unemployment, and even the best of minds are speculating as to where this will all reconfigure. But what's happening realistically, really, is there's a lot of junk debt out there, and rated companies that were borrowing for share buyback purposes really weren't growing their businesses, and those guys are now facing some serious issues. The fact that their equity is gone or down or compressed, and that they're now probably paying 8 to 9 points on junk-rated debt will create, fallouts and bankruptcies. So one thing to keep in mind is that this economy is a large locomotive. It has to gather steam once we push this forward. Again, industrial is in the front car, and retail's pulling up the caboose. But they're all gonna, once it gets the engines primed and it's moving, it's gonna get going. Not a juggernaut, obviously, as we see things slow down, but The recovery really looks more to be drawn out currently than a V-shaped spike return like many had talked about. And there's people talking about a Q3, Q4 comeback and ramp up to normalcy. I think that's dependent on, too, like the treatments that people have. And if there's a vaccine, obviously vaccine, who knows when that's coming out, but there are treatment programs coming into play that definitely can lessen severity. And with, like I said in the beginning, a strong sense of just unmitigated testing, that coupled with some good treatments for people could definitely help revive the economy as we need it to do. So one thing we have to keep in mind, and I'm kind of circling the wagons here to end this up, and I really appreciate you guys listening. And if you have any comments, like I said, leave them below on the YouTube page, or give me a call, shoot me an email. Let's figure you out, get you any information you need. But one thing that we have to keep in mind, and this is, if you're listening in the States, cool, great, give me a call if you need more information. This is kind of just focused on people in the area right now that is kind of the GTA, as that's where my business is focused. More than willing to move forward with my European clients. Hi, guys. Hope you're listening as well as my American ones. But to focus in on what I think we have to keep in mind for the majority of people listening to this broadcast is that we have to recognize that Toronto is now bigger than Chicago. They, along with Los Angeles and New York, make up the 4 biggest ports in North America, and Toronto will remain one of the largest distribution hubs going forward. That being said, some economists I read speculated, it's the proximity to intermodal hubs that are going to dictate how quickly an area returns to normalcy after pre-COVID. And going forward, we have to keep in mind there's intermodal yards all around Toronto. And for those in Halton, if you don't know, the CN Intermodal Yard it's on tap. It's coming out. It's going to be, South Milton, north of Burlington. So anyway, going forward, I would speculate that manufacturing will fall back. It's going to get clawed back. It's going to come back to the States and Mexico. And Canada are going to be standing on their own in a reconfigured world market, right? It's going to change trading patterns as we see a resurgence in manufacturing, and in turn, smaller scale businesses that exist to support larger manufacturers are going to flourish. Obviously, this is kind of blue sky stuff. I'm talking about what's coming down the line. But as we open the gates and turn the dial up and bring our economy back to life, there are positive, indicators of change that's coming that will be good for everyone. I know this is awful and we're all having a hard time dealing with it. But, if the manufacturer, and I would say, like, for those that are in business, like, look at how to expand your manufacturing. Because at the end of the day, it's community-based approach as well. Obviously, bottom lines are a thing, but there is a way to make money, and we can all do it if we work together. Because if you look at the larger manufacturers, and I would say, if you're talking to business leaders or, community leaders, talk to them to find out ways to help incentivize big business coming back. Like, that should be a big part of this conversation, where we're headed, because for every large manufacturing job, say in Toyota or Linamar, outside of that is 3 to 5 tertiary jobs, wrench turners, janitors, people doing work that supports those companies. So for every job, 3 to 5 more can show up. So let's, make that a part of the conversation in all communities. We don't want to, throw off the manufacturing sector as it exists. We just want to recalibrate it and make sure that everybody has an opportunity again as we move forward, right? So this in turn, I think, could push the industrial inventory back into equilibrium with warehousing and logistics groups, and in turn fall back to the reflection I keep coming back to, that the industrial real estate sector will be the strongest coming out of this recession. However it plays out, industrial is the strongest thing to hold on to. If you're looking to get into the market, it'll be a great time to do it. Like I said, there will be few select opportunities. If you're looking for something, feel free to reach out, or if you just want to have a conversation, get some further information. I'm available. As you see on the screen, my contact information is there. I look forward to hearing from some of you, or all of you. Please do yourself a favor, share this with people you think it might help them out, and get them some good information. And if you want to initiate a conversation, do feel free to reach out. Okay, so it's May 1st. This is Blake Preston. I'm signing off, but thank you very much for tuning in. I look forward to hearing from any and all of you, and we'll be doing another podcast shortly when time dictates. Stay safe, stay healthy, and above all else, keep busy. And I guess if you're Canadian, keep fit and have fun. Thanks for tuning in, guys. Talk to you soon. Bye.